All right. All right. Hello, everyone. As people are getting connected, I will say welcome. It's Mark Yusko from beautiful Chapel Hill, beautiful spring day. The only problem is, excuse me, the pollen is brutal this year. So I apologize for my voice in advance. Um, so we are going to do the third installment. Didn't plan for it to be three installments. But seems like it is tariffs everywhere. And since we went with the rhyme of the ancient mariner, the new chapter, I guess, is will the economy sink? So you've got the president up here with his house on fire, smiling, like, yeah, no problem. And then trying to put together the puzzle pieces of tariffs with inflation and deficits and should I make some exemptions and looking a little bit puzzled. So water everywhere and all the boards did shrink. Water everywhere nor any drop to drink. That is the original line from the rhyme of the ancient mariner. And, it probably makes sense to talk about captain of the ship and being at sea and stormy seas make for good sailors. We certainly have stormy seas because these idea that trade wars are good and easy to win, and tariff being the most beautiful word. I think those are just stupid statements. I don't know if he makes it for bombast or if I hope he actually doesn't believe it. But as history has repeatedly proven, one trade tariff begets another and another until you got a full-blown trade war. No one ever wins, and consumers always get screwed. In the vernacular, the benefits of tariff are visible. Union workers can see they're protected. The harm which a tariff does is invisible, spread widely. There are people who don't have jobs because of tariffs, but they actually don't know it. From Milton Friedman. I love that part. So protectionism is a misnomer. The only people protected by tariffs, quotas, or trade restrictions are those engaged in uneconomic and wasteful activity. That is the key line. Free trade is the only philosophy compatible with international peace and prosperity. And so last time in the second edition, we talked about truer words of wisdom. Said, you see it first when someone says, let's impose tariffs on foreign imports. It looks like they're doing the patriotic thing by protecting American products and jobs. And sometimes for a short while it works, but only for a short time. What eventually occurs is homegrown industries start relying on government protection in the form of high tariffs. They stop competing. They stop making innovative management and technological changes they need to succeed in the world markets. And then, while this is going on, something even worse happens. High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. The result is more and more tariffs, as we'll talk about, higher and higher trade barriers and less competition. So soon, because the price is made artificially high by tariffs that subsidize inefficiency and poor management, people stop buying. That's when the worst happens. Markets shrink and collapse, businesses and industries shut down, and millions of people lose their jobs. From Ronnie. Now, the truest words of wisdom were spoken well over a century ago by Adam Smith, literally the GOAT of economics. In every country, it always is and must be the interest of the great body of the people to buy whatever they want of those who sell it cheapest. The proposition is so very manifest that it seems ridiculous to take any pains to prove it, nor could it ever have been called in question had not the interested sophistry of merchants and manufacturers confounded the common sense of mankind. I love the way they talked back then. But this is so true. You have to actually make people believe in uncommon sense, right? Their interest is, in this respect, directly opposite that to the great body of people. The only people who could ever favor these ideas are the people at the top, not the masses, not, in theory, the people that the government works for. Okay. is in the interest of freemen of a corporation to hinder the rest of inhabitants from employing any workmen but themselves. So it's in the interest of the merchants and manufacturers of every country to secure to themselves the monopoly of the home market. So the people at the top think that they will be better off by isolating themselves. And he was talking about Great Britain. Hence, in Great Britain and most other European countries, the extraordinary duties upon almost all goods imported by alien merchants, hence the high duties and prohibitions upon those foreign manufacturers that come into competition with their own. Hence, too, the extraordinary restraints upon the importation of almost all sorts of goods from those countries which the balance of trade is supposed to be disadvantageous, that is, from those against whom national animosity happens to be most violently inflamed. Again, I just love the way they talk back then. And basically what he's saying is everything that these people are saying is in direct opposition to the people they're supposed to be serving. And it's only in their interests to try to make this game work. But the harder they fight, it's like quicksand, the further they sink. Again, let's be clear, a tariff is a tax. It is paid by the importer. It is not paid by the exporter. It is not paid by the other country or the other. It's paid by the importer. If you're a mom and pop shop and you have goods made in China and they show up in the U.S., you, the mom and pop shop, pay the tariff. It's just a lie to say that the company doing or the country doing the exporting pays the tariff. They just don't. There are winners and losers. And as we said, domestic industries uncompetitive on world markets, sure, they win. That's the whole point. That's why people came up with the stupid idea in the first place. The workers, particularly unionized workers, they win. And government tax revenue does increase by a small amount. That's true. The losers are anyone who actually wants to export stuff. The consumers who end up paying higher prices. So this idea that they're not inflationary. They're not inflationary in the sense of monetary inflation, but they're absolutely inflationary in that you have to expend more dollars to get your goods. Domestic industries who see lower demand due to more spent on imports. Okay, that's a big loser. And domestic exporters who experience retaliatory tariffs. So if you're selling ginger that you grow in Minnesota to the people in China, you get messed up, or soybeans for that matter. Now, the tariffs were popular in the 1800s. Why? Well, because, I'll explain why in a second, because the last time they were popular was in the 1700s. And it takes 100 years to forget how dumb an idea they really are. So in the 1800s, people fancied themselves patriots and even ran entire platforms on the far left based on this idea of protection. Now, tariffs were, think about this, they were the only source of funding for governments until 1913. So what's interesting about this is Trump talks about he wants to abolish the income tax and have all the money made by tariffs. You realize it's picking the same pocket. So the reason that he has this artificially it's not artificial, this mistaken belief that somehow tariff income is better than income for governments is he read or someone told him about this history and said, well, there was a period for most of the Republic's history, 150 of the 250 years, where you didn't have income taxes. All you had was tariffs. Well, but then we did away with tariffs because they were a bad idea. And now the income tax wasn't really a good idea either. We should have a consumption tax, but that's a whole nother story. But it's interesting how everything changed in 1913. Also the time when the Fed was created, by the way. Now, this is a cartoon from the 1800s, and it basically shows that the robber barons were coming back. So this whole idea, so this is actually from the late, early 1900s, sorry, 1910. And they were going to introduce this idea of taxing people to pay for what the robber barons did, right? Hence the term robber barons. They were robbing the people of their hard-earned money. And it was the same way up in the upper left that the medieval lords demanded you give them a part of your harvest. So the robber barons has been around for centuries, and it's always the same. The people at the top demanding by force. You notice that they're carrying swords. It's by threat of violence that you're able to extract the wealth from the peasants, as you know, Trump just called the Chinese. So tariffs on the left-hand side had been disappearing for a century. From 1820 to 1929, they had been disappearing until Smoot and Hawley, which had obviously never read history, said, oh, we got a good idea. Let's try tariffs. Not only was it a bad idea, on the left-hand side, it basically shut down global trade for almost 50 years. Just think about that. So it basically shut down global trade. I'm sorry, for 30 years. It was already shut down because of World War I. But we've done this mass tariff thing 3 times in American history, 1828, 1930, and 2025. 100 years apart, because the last 2 times caused depression. And it takes 3 generations to forget how bad an idea, because everyone needs to be dead. And this one's going to totally make us rich, though, right? So Tariff Man, he came back at Trump 45. He had this fantasy that by installing tariffs, somehow he would reshore American jobs and he would lower this trade deficit that we have with China, or China, as he likes to call it. Instead, it went up 3 times. 3 times. So obviously it didn't work. And the reason it didn't work is a very simple point of economics. If you export money abroad, you have to buy something for that money. So you have to buy goods. So if we print money, all right, and we send it to foreign countries to buy goods, we will have an imbalance of trade. It's like there was this great thing on the internet, this woman who is she's a homemaker but has a business, a catering business. And she said, you know, I have a massive trade deficit with the grocery store. I buy everything from them and they buy nothing from me. So, you know, I should start charging them tariffs, or, you know, maybe I should just grow my own wheat and mill my own flour and grow my own fruit in the backyard. No, that's dumb. Trade for specialized purposes is the nature of how economics works. And so you're not going to fix those imbalances with tariffs. It's impossible. Now, in 2018, most people still understood how dumb tariffs were, and there was no support. Today, shockingly to me anyway, at least half the people think it's a good idea because they've been convinced that somehow there's an unfair playing field globally. Yeah, but pesky facts. The fact on the left-hand side is even before the Trump plan, the U.S. had nearly the highest tariffs in the world. Even though we didn't have very many, we had nearly the highest in the world. And now we've got the same tariffs as the Great Depression. So the 25 plan is focused on this U.S.-China trade imbalance, and somehow he thinks it's going to be different this time. It's just not. And he's doubled down on his rhetoric, and he's threatened a full-on global trade war. Even Ferris Bueller knew that trade wars were bad. Great scene from Ferris Bueller on a number of things. But the idea that somehow escalating tariffs higher and higher is a good idea and somehow relates to the art of the deal. So Trump declared April 2nd Liberation Day to make America wealthy again. The Economist saw right through it and said, dude, this is Ruination Day. You're cutting yourself a hole in the floor. The market reaction to Trump tariffs is the second worst this century. Just let that sink in. The only year worse than this to this point was 1937, right in the middle of the Great Depression. So the announcement of the tariffs, or if the first around the world we did on tariffs, literally was at the market peak. The second one, we rolled over again, and then Liberation Day, it's just been straight downhill. So the Treasury Secretary says tariffs could bring in substantial revenue. Yeah, kinda. I mean, a few billion here, a few billion there, but there's a problem. Last time, we brought in $30 billion. Okay, that's not nothing, but 28 billion of it went to the farmers in a bailout. So wait a minute, 92% of all this wealth that's being created for the government gets paid out to the farmers who you're screwing because they can't. The next slide. Look what happened in 2018. I'm sorry, 16, 17, 18 to soybean exports, to corn exports. Okay. They plummeted. So you raise tariffs to force farmers into bankruptcy. You rescue the farmers with aid and tell the American public they should support American farmers. Whoa, 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 whoa. None of us signed up to pay extra taxes to give it to farmers who could farm goods and sell them if it weren't for the dumb tariffs. So this thing yesterday, our farmers are great, but because of their greatness, they're always put on the front line with our adversaries, such as China. Okay, in trade, yada, 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 yada. He blamed corrupt Joe Biden, crooked Joe Biden, and all this. We will protect our farmers. So he's basically saying, I'm going to give all the money to the farmers again because, yes, the Chinese are going to retaliate and they're not going to take our soybeans and it's all going to go to Brazil. So Trump demands China call him to make a deal. President Xi declines. Call's not coming. So what does Trump do? He says, all right, fine. More tariffs. Bigger tariffs. The most beautiful tariffs you've ever seen. 245% tariffs. And China's like, you know what? Above 100% is just stupid because that makes it like an embargo. So what does China say? You know what? No goods for you. They're going to suspend cargo service to the U.S. That's going to be a problem. We've had this before. Remember in lockdowns when we couldn't get ships into and out of ports? We know how this ends. Not good for the American consumer. Oh, yeah. And then they said, and those rare earth minerals you need to make your iPhones, which you can't make a phone without rare earth minerals, we have 90+% monopoly on most of those. So you're not getting any. Zero. Like zero, zero? And, oh, by the way, those airplanes that you ship us, because the only thing you really make in the United States are airplanes and cars. Well, we make oil, but they don't buy any from us anyway. They buy it from Russia. Yeah, we're going to not buy any planes from Boeing. So Boeing stock went down. All right. WTO said, you know, this is bad. We got a full-blown trade war going on. So we're going to basically say there's going to be no growth in global trade this year. Down from 2.7%. Okay, that's bad. Because we know that U.S. profits follow exports and global trade. Perfect correlation on the left-hand side. So this idea that globalization is somehow going to be good for markets doesn't make sense. So global investor growth expectations have actually fallen to record lows. We've actually never seen anything like this. And again, I'm not a statistician, but the correlation of the light blue line and the dark blue line are really, really high. Dark blue line is export growth expectations, and the light blue line is the S&P. So this is implying about a 40% downside from here. Ugly. Now, the popularity of our commander-in-chief is falling. I mean, it's not falling as fast as maybe a lot of people would have expected, but it's down. It's up to 52% disapprove. But on the handling of the economy, ooh, that's down a lot. That's even worse than, the last couple. We also know what happened to the last set of Republicans who tried this. It was a blue wave in the next election. I mean, that's a big blue wave. I didn't realize it was that big. All right, so what does this mean for the surprises? Trade wars was the biggest thing we were worried about. We thought that a surprise would be that there'd be a recession. Well, search term for recession starting to peak. Markets are pricing in a recession about 50%. Polymarket says 55% chance. The recession probability indicator is up towards 66%. Fed says, don't worry about it. Leading economic indicators, we're already in recession. But NBR hasn't declared it, so technically we're not. But according to the LEI, we've never been here and not been in recession, so pretty much we have to be. The soft economic data, absolutely in recession. Soft data always lead the hard data. Now, you did have one period in 23 where the hard data diverged. If the Fed were to step in, it could delay the inevitable, but the soft data is telling us a recession's coming. Job cuts. We haven't seen job cuts like this really other than COVID. I mean, these are worse than the tech bubble in 2000 and the global financial crisis. I mean, that's saying something. And expectations of employment, again, are the worst ever. And the fact that I keep having to say record or worst ever or highest ever, those are not good trends. Consumer sentiment at levels, again, we've never seen in history, particularly for personal finances. People just don't feel comfortable with where they are. Mortgage rates surging again, and insidiously, people are trying to refinance their mortgage before rates rise. The banks are just saying, nope, I like higher rates, so I'm just going to decline almost half of the mortgage applications. Americans are falling behind on their car payments. And, while 6% is not a huge number, I mean, the average is closer to 3%, so it's double the average. And again, a third of loan applications are being rejected. That just is a big deal. Credit card delinquencies, they're not out of control, but they've, grown a lot and are accelerating, particularly on the unsecured and the subprime area. Bankruptcy filings on trend for global financial crisis level will probably exceed the GFC at the rate we're going, and it implies on the right-hand side about a 2% contraction in GDP this year, despite the fact that people think we're going to grow. BlackRock guy, not Larry Fink, but Rick Reeder, who's their chief economist, basically went on television and said, we're in recession. It's not coming. We're in recession. And he said it very clearly. He said, we're adding cash and gold to portfolios. And consumers agree. They think things are bad. Consumers, because they're worried about tariffs, rushed out. So the positive is, hey, but retail sales are great and auto sales are great. Well, yes, in March, people bought cars and goods because they're worried that, tariffs are going to make the prices higher. But they did do that, so that's true. The Fed math ain't mathin'. The Fed is saying we're going to grow 1.7% GDP this year. It's going to be really tough if you have 2.2% negative GDP growth in the first quarter, which is what GDP Now is telling us. On the positive side, recessions are usually short. So if we're already in it, it's probably almost over. The market impact outside of the global financial crisis and the dot-com bust really aren't that big. And, we're already down 10-ish%. So maybe we're halfway through. I actually think this is probably like the 2001 period. Second quarter was negative. First quarter was negative. Second quarter was positive. Third quarter was negative. Fourth quarter was positive. The whole year was about 1%. That's recessionary, but not a disaster. Market troughed in April, down about 15%. Then it rallied on hope that everything was fixed with Enron and WorldCom. Through summer, got back to flat. Then it crashed 25% because they restated all the earnings of all the bad companies like Cisco. And we finished only down 13% for the year. So, that sounds reasonable. Not a 40 or 50% decline, but a 15%er. All right. Printer is coming. Ned Stark said challenges are on the way. Indeed, they are inevitable. Printer is the only solution. Look, we're in the third great bond bear market. It's putting huge pressure on interest costs, which we'll come to in a minute. The Fed decided to shapeshift into Dove and said, I can fix it. So he cut rates last year. Well, maybe not. Rates actually didn't go down. They rose. That's never happened before. That was weird. The 30-year bond actually made a perfect decline in the second half of last year and was basically saying, yields went up and prices went down. And so there was a reversal almost to the day. And it went straight up from the day that everybody sold TLT right up to Liberation Day, and then completely crashed because people are worried. So Mr. Market says, there's a typo, there's always three, J. Powell shapeshifted back to Dove. Jerome, the hawk, says, not so fast. I will do it when I want. So he's not cutting rates anytime soon. Mr. Market says Jerome's serious about waiting, basically saying 80% chance of no cut in May. So Donald set to Twitter and said that Powell needs to be, fired immediately. Couldn't come fast enough, and that he's an idiot, and it's a mess. Now, ridiculing people. Now, remember, he's the one that put Powell into the office. It was his hand-picked choice over 3 or 4 other people that other people wanted. He picked Jerome. And yes, he's had his problems with Jerome back in 2018 when, Jerome was raising rates and he wanted him to cut rates, and he did eventually browbeat him into doing it. But, this is childish, if you ask me. So Fed balance sheet, basically, Polymarket's telling us 100% chance, which you almost never say 100%, that they're done with QT, meaning they're not going to shrink their balance sheet anymore. Printer is indeed coming. M2 growth is rising in the U.S. on the left-hand side. Globally, M2 is going vertical. I mean, it's literally going vertical, particularly in the last 2 weeks post Liberation Day. People are saying, well, we better fire up the money printers. Now, the narrative was that Trump was intentionally crashing the economy. Just think about saying that out loud, that people actually believed that nonsense, that he was intentionally crashing the economy in order to lower rates because he couldn't control Jerome Powell. So therefore, he was going to crash the economy at lower rates. The problem is, on the right-hand side, he didn't lower rates. Rates actually have gone almost straight up because, and we'll talk about why, the people who hold our bonds are selling them because they can. Economic policy uncertainty hits a new all-time high, dislocates from credit spreads, therefore lower quality debt assets are not buying the narrative and they have rolled over hard, both high yield bonds and BDCs. So nothing good happens below the 200-day moving average. So if they don't hold the 200-day, it could get ugly in a hurry. All right, the bear and the maiden fair. The surprise would be that the bear market comes back. The economist said, well, why even bother with anything except the U.S.? Best 2 years in the history of markets. Portfolio managers back in January, no one was buying protection, which usually means that's the time you need protection. And so what you see here is when no one was buying protection, the market was basically fine. And then it headed down, and then it kind of started to recover. And then on Liberation Day, it went straight down. And now in the circle, the red circle has made what's called a death cross, meaning the 50-day cross, the 200-day. That usually doesn't bode well for prices, but doesn't mean absolutely, but it's not a good thing. So has the bear been released from the ICU? Depends on which market you're looking at, depends on your definition of bear market. The history of bear markets is you have to have a 20% drop. NASDAQ has had that. Plenty of stocks have had that, but the Dow and the S&P have not. So we're in the teens-ish. It depends. You're talking about the average bear market, a structural bear market, a cyclical bear market, an event-driven bear market. So there are lots of definitions, but at the end of the day, it doesn't feel good right now if you own equities. Portfolio managers, record selling. Again, there's that record word. We've never seen intentions to sell. So they do this survey and they say, okay, well, if you own equities, do you plan on buying or selling over the next period of months? And we actually never seen this level of expected sales by institutional investors. And it's like 300 plus trillion of assets around the world. I mean, it's a lot. 300 trillion, about half of the global markets, about half of the global assets. Both institutions and retail investors believe future equity returns will be lower. So on the left-hand side, institutions, we're selling. We're planning to sell more because we think future returns are going to be low. Consumers, retail, we think returns are going to be low. But here's the weird thing. So the smart money, left-hand side, purple line and orange line, are selling. Nope, I got this backwards. The green line and the blue line, and on the far right-hand side, the light blue line. The smart money is not buying and is in fact selling. The dumb money, the retail, the dark blue line on the far right, is actually buying, and what they're buying is tech. So buy the dip has become this learned behavior in the last 20 years, and the Fed put has created this crazy Pavlovian, and part of it's also there's so much money in passive, so it's not actually thinking. It just has to do it. But the correlation between the retail buying and selling and market current direction is pretty exquisite. And on the bottom right-hand side, it's all going into the same Mag 7 tech stocks. In fact, people have bought more Mag 7 stocks in the past 6 weeks than they did in Q1. It's crazy. So tariffs create uncertainty. Markets hate uncertainty. But when economic uncertainty peaks, that's actually usually a buy signal. So I'm not saying buy here, but it is interesting. Now, VIX is what most people think of as a volatility indicator, and they think about it as a way to tell them when to hedge. The problem is you don't get to wait until you know. So when it's low, like when it's below 12 in blue, nothing bad is going to happen. And then when it's between 12 and 14, basically the market is saying nothing bad will ever happen. And when it starts to go up, it's like, well, nothing bad's really happening. So when it starts to breach above 17, maybe something bad would happen. But the problem is then it immediately jumps to the 20s and 30s when the bad thing is actually happening. And by the time people pay attention to it and say, oh, look, it's at 40, well, then it's over. So that means it happened past tense. So yes, VIX was only higher 11% of the time when it hit 30, but the bad thing had already happened. So now VIX is rolled back over and markets have stabilized a little bit and there isn't the panic selling. Now, depending on the next, foray shot across the bow, we'll see. Now, stocks have, there's another typo, should be capital S. U.S. stocks have indeed gone down. You still can't call them cheap. The S&P is still well above average. And, it's not in the top 5% any longer. It's still in the top quartile expensive. NASDAQ still top quartile expensive. Small caps are getting a little bit cheap. And mid caps are about the only thing that you might be able to call cheap. The average U.S. equity model, still 3 standard deviations expensive. So let that sink in for a second. So it's still saying it's 130% overvalued, meaning you'd have to drop about 60 odd percent to get to fair value. And the Buffett indicator is 2 standard deviations away. It's not the worst reading we've ever seen, but it's pretty close. And it's basically saying we need to drop minimum 50% to fair value, maybe even a little more. History also does not favor where we are. If you have a 15% drawdown in any period, you're not very likely to have a positive return. And the only time we actually had positive return is when there was extraordinary stimulus, fiscal or monetary. So absent one of those happening, like it did in 82, 09, and 2020, we're going to have a negative year. So earnings, not helping. Earnings are collapsing. Earnings estimates are falling again at the fastest rate we've seen in decades. Not quite as bad as 2020, but a close second and getting worse. GMOs projecting very bad negative returns for stocks, even in the event that J-Pow goes full dove. You're still going to lose money over the next decade in U.S. stocks, not international stocks or emerging market stocks, but U.S. stocks. All right, laws of God and men. MAG stands for must acknowledge gravity. So top 10 stocks, 47% of the index, equity concentration, never been higher. Everybody was overconfident, so everybody was overweight. Mag 7 turned into Lag 7. Just let this sink in. Shed $10 trillion in weeks, not years, weeks, 10 trillion, and then went up 4 trillion in one day on the reversal or the pause of tariffs. We have casinoized the capital markets. So Mag 7 valuations nearing 2-year lows. Now, still polluted by a lot of bad data, but are 2-year lows, and not as highly overvalued relative to the S&P. Still 50% higher valuation, but less bad than it was. Look, NVIDIA was priced for perfection. They had the glitch. And so, and they had their DeepSeek moment and it started to roll over. The problem is the hits just keep coming. So on Sunday, the president said, all right, Apple, NVIDIA, you guys are exempt from tariffs. And then he changed his mind and said, nope, you can't sell any chips to China. And so the stock fell 5%. I think it ended up 10% for the day that day. When you look at it versus Cisco versus they're not the same. They kind of look the same. So it is feeling a lot like 2001, and NVIDIA could go down a lot. Did Tesla have their DeepSeek moment with BYD? It appears so. Tesla keeps going down. BYD keeps going up. And Palantir, yeah, it's returned to normal. Everybody thinks it's fine. This stock's so overvalued. It makes Tesla almost look cheap. Tesla will never be cheap, but makes it almost look cheap. All right, now his watch has ended. DXY shrivels back to banner form after being the Hulk all last year. The dollar's in a long-term secular downtrend. I mean, yes, it is cyclical uptrends, but secularly, we've been falling since 1981, and we're going to continue to fall. That's just the nature of fiat currencies. That's good for commodities. So commodities are probably going to be the place to be. Therefore, it shouldn't be a surprise that the dollar is having one of its worst starts to a year in history. I think it's the second worst year in the last 100. And therefore, all the commodity currencies like the ruble, who would have thought the ruble would actually be a good thing, but it's up almost 40% against the dollar. Gold, silver, Swiss franc, all the commodity currencies are higher. Let's keep the dollar move in perspective. So over the past 5 years, the dollar was basically dead flat, and it went up a lot in 24, so it was likely to go down in 25, just like clockwork. We gave back all the 24 gains, and we're on the verge of now making the 10-year number zero. So life comes at you fast. What a difference a few months make. We went from the envy of the world to how a dollar crisis would unfold. It's just amazing. Dollar crisis? We're talking about a crisis? Gentle reminder, 80% of all the dollars ever created in 249 years of the Republic were created in the past 5 years. Therefore, monetary devaluation is very different. That's true inflation. Very different than what is reported as inflation. So reported inflation, CPI, since 2000 says 88%. The actual monetary devaluation is closer to 363%. That's much worse. The House of Black and White, oil prices, the surprise would be that, Saudi somehow turns off the pumps and gets prices back to where they need them at $100. EIA says the prices are flat, market's always in balance, yada, yada, yada. Trump threatened OPEC. OPEC politely declined and, kept production solid. Oil prices were meandering down. And then Liberation Day, they collapsed. So Saudi has not cut production, despite if they did, they could control the price. But So maybe they politely declined, but maybe they agreed behind the closed door with Trump. I don't know. Energy stocks, so out of favor. It's usually the best time to buy. Investors had pushed oil stocks to really oversold levels. We made a perfect double bottom. We talked about this last time, and they have rocketed up off that double bottom, which is kind of interesting. We love MLPs. They have crushed the S&P over the last couple of years, and particularly this year. Now, they did get whacked on Liberation Day, even though they shouldn't have, because they don't care about the price of oil. And they have rebounded nicely, but when people get liquidated, they sell everything, including the things that generate cash flow. The red woman, crazy Christine, crafty Christine, was going to cut rates despite the fact that she needs a weaker currency, not a stronger currency. But Germany found out the hard way. Trade wars are not easy to win. They slapped some tariffs on China. China said, ha ha, we'll just take all your factories and not buy any of your cars. Germany's economic decline has been nothing short of epic, in recession as we speak. This morning, the ECB, or maybe yesterday, ECB cut rates again, seventh time. And that's because inflation fell. So now they've gotten short rates back to the inflation rate, which is where they should be. That's the way history has been long term. So she's got the printer on maximum burr. What Europe needs is a weak euro. The only way you can be a mercantile state, meaning sell goods to the world, is to have a weak currency. And they were doing great. The currency was weakening. She was cutting rates. Well, now the currency is strengthening. So every time she's cutting rates as hard as she can, but rates are going the wrong way. So what the hell's going on? Well, people hate their bonds. So European stocks, on the other hand, had been dead money for a year and then took off. Even Liberation Day wasn't enough to kill them. They're still up more than U.S. stocks, meaningfully. And part of it's because the bond market is getting routed in Europe, which is good for the banks. So European banks are surging up, almost 30% year to date. I mean, this is a crazy story. It's been great. Deutsche Bank crushing JP Morgan. Look, Europe underperformed for 2 decades. Investors, though, are starting to pile in. European equities, best performing markets year to date. Big surprise to investors. Spain, Greece, Italy at the top. Really? I mean, vacation countries at the top. Crushing the S&P and QQQ. The Night of Seven Kingdoms. Ueda-san has come in, and he is he's not a politician. He's an academic. He thinks he has the answer. He's not going to listen to reason, and he's going to raise rates, markets be damned. Japanese economic growth has been stagnant for just about ever. Economic indicators stink, technical term, but he's going to raise rates. And what happened? Japanese 30-year bonds have lost control. This is who's selling U.S. bonds. It's not the Chinese. I mean, it is the Chinese too, but it's also the Japanese because their hedge funds are getting crushed. And they are having to liquidate bonds, and that's putting pressure on U.S. interest rates. So there's this death spiral that's happening as Japanese bonds go up. That unwinds the Japanese yen carry trade. And Ueda-san, it's all his fault, but he didn't seem to care. I mean, he is stoic. I will give him credit. I mean, since he started this nonsense back in January, it has just been a one-way trip for the yen on the right-hand side. And inflation is back. I mean, I was just in Japan for 2 weeks, and inflation is back. I mean, it wasn't horrible, but, it was not like the good old days of everything being super cheap. Japanese corporate profit growth has collapsed. And look, where the head goes, the body follows. It's my wrestling coach taught me years ago. And the yen is strengthening, and therefore Japanese stocks, they are the land of the setting sun, not the rising sun. All right, the dragon and the wolf. Shanghai index continues to fly despite the trade war. Look, China had given back all their gains from the 2000s, even though they were growing, more than twice as fast. No movement in their stock prices. Media says just a matter of time before their failed plan tanks the Chinese markets. But here's the thing. They hold the cards. They hold our debt, and they can sell the debt. Well, why would that matter? Well, they know we have to refinance all this debt. And so if they lower rates, that gives the PBOC more capacity to inject liquidity into their economy. They have lots of room on the left-hand side to expand their balance sheet so they can lower rates. And despite the rhetoric that the renminbi is collapsing and Kyle Bass says they're going to fold, it's basically dead flat over the past 3 years. So yes, it is weakening, but that's their whole plan. They're weakening the yen so they can sell more goods to the rest of the world. So who's laughing now? That was, the yuan. That was their plan all along. And their trade is going up. So no one wins in a trade war? Yeah, no one wins, but China loses the least. And the U.S. is the biggest loser. And it's not close. So Chinese equities bounced off the 200-day moving average. They were up, high 20%. Yes, they got whacked on Liberation Day, but they're super cheap and they're positive for the year with U.S. stocks negative. A shares hurt more by tariffs because they can't compete globally. But their valuations are at super extremes. Tech stocks were off to their best start ever, actually, but they had a long way to go to get back to fair value. President Xi, he loves tech now. He hated tech. Now he loves tech. U.S., we're threatening them with delisting their tech companies. They're like, fine, we'll bring them back to Hong Kong. So Chinese tech stocks did get hit, but they're super cheap. Like, why would you own U.S. tech stocks when you could own Chinese tech stocks? They're same growth rates. One's way cheaper. I don't know. Another casualty of trade wars, U.S. retail. So basically, Shein and Temu are kicking the crud out of U.S. retailers. Target's down, dollar stores are down, everything's down. And so we put tariffs. So now Temu says, we're just going to raise our prices. And all you people that love our cheap prices, tough. Blame your president. So the Terrific 10 has beat the Mag 7, but no one cares. Everyone's still long U.S. tech. No one owns China tech except Dave Tepper because he doesn't care about tariffs. He said it on TV. Why does he not care? Because China doesn't care about the U.S. We are 8% of their exports. More than 50% of their exports are the Pacific and Europe. And it's now privatized businesses. This is why Xi is embracing tech. It's gone are the days of the SOEs dominating everything on the far left. It's all about private enterprise and becoming a manufacturing powerhouse that will transition to a consumption powerhouse. The U.S. press paints the picture of China dependence. It's actually the opposite. We are dependent on China for everything that's complex. Yes, they are dependent on us for things like soybeans and raw materials, but they can get those raw materials from other places, which is what they're doing. And they own these little things called rare earths, and so they're not going to give them to us. And Trump finally, or somebody in Trump's administration, figured that out and said, you know what? Smartphones, you're exempt. So the flip-flopping is real, and we'll see how this plays out. But Apple iPhones are not going to be made in America, despite Lutnick saying we're going to have millions of Americans screwing in the little screws. Not going to happen. So Trump says he holds all the cards, and she's like, well, the cards are made in China, and they have all the chips. They have the big stack. They can buy the pot. So breaker chains, and I'm running out of time, and I know there's some questions. Winter returns, prices peak at 150, fall hard in the second half. Look, history of fiat currencies, they all go out of business. Bitcoin is the first money that requires no physical space to store, no courier to carry it, no bookkeeper to count it, no auditor to check on it, no security guard to protect it, and no government to issue it. It is the perfect money. Bitcoin fixes the fiat problem that has existed for millennia. Now, gold's been money for 5,000 years. Home's been a store of value. Bitcoin's better than both. You know, gold used to be 2.4 Bitcoin per gold bar. Now it's 0.03 Bitcoin, okay, per ounce of gold, not gold bar, ounce of gold. U.S. house price used to cost 668 Bitcoin to buy a house. Now it's 4.9. The Big Mac Index, one way to monitor the theft of our purchasing power. So it's gone from 353 to 569. And the problem is you used to actually get to all beef patty, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. Now you get a bunch of shit, pardon my French, but I wouldn't put this in my body. I mean, you don't even get real food. You used to get real food. To all beef patty, special sauce, lettuce, cheese. Well, maybe the special sauce wasn't real, but it was real food. Now you don't even get that. And look at the price in Bitcoin. 42 Bitcoin in 2010, 0.0000. It's a better deal. So Bitcoin adoption is real. It's following the internet. It's just technology. People were convinced we'd have a fall back to 72K, and then we'd go to 150, almost like clockwork, right? We got there. We had a tax day correction. People had to sell to pay their taxes because people had a lot of things. Despite the pullback, it's still the best performing asset since the election. It's kind of interesting. And we did hit the 72K almost exactly. It's pretty wild. Now, will we go to 150K? I don't know. Fair value is around 95K. If you look at the power law, maybe 100K. If you look at the historical trends, that we should get somewhere between 150 and 170 by October-ish. And then we have a crypto winter in 2026. Bitcoin prices are seasonal. You get 3 up years. Odd years are always positive, and the second half of the year is the best part. Bitcoin treasury strategies beating everybody. Buying MicroStrategy is beating the Mag 7. It's beating everything in the U.S. stock market, and it's not close. Little Meta Planet is now the number 10 holder of Bitcoin in the world. It's pretty cool. Gold market cap has surged $5 trillion. So congrats to Peter Schiff and everybody who loves gold. Half of that is monetary, about 10 trillion. Bitcoin's only about 1.7 trillion. That's a 6x from here. Easy. It's not even trying very hard. I didn't put the title on this. This basically, how much Bitcoin does it take to retire a family? Today, it's somewhere around 30 Bitcoin. If you had 30 Bitcoin, you could retire your whole family. By the end of 2028, it says it could only be 13. It's a pretty interesting way to think about it. It's the perfect savings technology, which is what the title should be. The Golden Crown surprises that gold continues to wear the crown and prices top 3,000. Oh, if only I weren't so conservative. Sounded crazy back when I said it. We're in a boom. Commodities usually do well. Dr. Copper was undecided. It was worried about trade wars. It did break out and then got broken by Trump. Liberation Day just crushed copper, but you can see it's bouncing again because you can't keep a good asset down. History of gold said that gold was going to do well. Central banks were buying it like crazy. China buying the most. Why? Because they're going to monetize their assets. Gold, it hit our 3,000 target like a knife through butter. And, on Liberation Day, it went back down, tested it, and now is rocketed another 10% to 3,300. All right, fine. Gold beat stocks in the last year, but what about 20? It beat that too. How about 25? Oh yeah, beat that too. Gold has beat stocks over 25 years. Nobody would believe that if you didn't see it here. Summarize, you don't own enough. Investors that abandoned the miners. Signs of life. Miners are minting money, but there was no one to care, no one to buy them. And so they started to take off in January, perfect cup and handle pattern, and it has been parabolic. Miners up 50% year to date, up 27% in 7 trading days until yesterday. They need to take a day off. Truly extraordinary. All right. Latest podcast, this is the second episode, Investment Environment Start to Stink, is back on the Around the World. And then you got Corey talking about strategy on hedge with capital D. And then every week we do digital currents. And X and I surprisingly talked about tariffs. Sell the tariffs, buy the dip. Buy some books. And I will look at questions. All right. All right. Was running correlations. First 37 days of the year, 85% correlated with 1937 and 1973. 85% correlation to 37 and 73. Ooh, don't like that at all. New monetary system, geopolitical, 1913, 1920s. Yeah, 2020. And look, this happens every 90 years. It's the fourth turning, if you've read that book. View on tariff is clear. What's your view on trade deficits, especially China? Should probably make, no. So look, trade deficits are natural and normal. And they go to specialization and comparative advantage. And again, this has been 500 years of economic theory proven over and over. If you can grow sheep in Ireland and grow wheat in the U.S., you shouldn't try to grow wheat in Ireland and try to grow sheep in the U.S. You should grow what you're good at and trade. So trade is normal. And poor countries always sell cheap materials and finished goods to wealthy countries. That's what we were from the 1800s to 1940. We were the emerging market run by a gang, and we sold stuff to Europe. And so there's a natural evolution. Now that we're the wealthiest country in the world, because we can print money out of thin air and we send it to people in exchange for goods, that means we're always going to have a deficit. Trade deficits are not good or bad. It's like that woman at the grocery store. We all have a trade deficit with a grocery store. The grocery store doesn't buy stuff from us unless we're farmers. Most of us aren't farmers. That's not a bad thing. So comparative advantage is real and is always good. So I think trying to address natural trade with policy is bad. Free and open markets are always better. Link for the slides. Absolutely. We just send an email to Evrana, EVRANA, at morgancreekcap.com, or L. Jacob, Leslie, and they can get you a link to the slides. The long story short is Microsoft created this bloatware problem. So my presentations used to be a few megs, now they're gigs, and they're just, they're too hard to send. So we'll send you a link, but absolutely you can do that. China can easily make the move we did in the nifty 50s and flip to consumption. That's what they're doing. 100%. China has a long-term plan. Their plan was to become a great socialism economy. That's what they did over the last 30 years. And how they did that was by bringing people out of the abject poverty into the middle class. The next 30 years, they will become a great socialist society, world superpower, by becoming a consumer-led society, and they will rely on Africa, Southeast Asia, and all the places through Belt and Road Initiative that they've created these alliances. And you saw in Kuala Lumpur, right? They lit up the towers in China's colors, not in America's colors. So gold miners now, look, they're overbought, so I wouldn't be rushing to buy them all right this second. But they're minting money, so I still think they're pretty good. Pomp and tariffs. I love Pomp, but I don't know what the hell he's smoking on his view on tariffs. I mean, I don't know if he's getting, I don't know. he interviewed Lutnick and he bought into the Kool-Aid. I just think he's wrong, and we're entitled to have different opinions, but um, economic history is not on Lutnick's and Bessent's. And the problem is they're all relying on this guy, Peter Navarro, who like refers to himself in his book, talks about Pete Naro or Navo or something, like this made up person that is him, crazy. And they're just wrong. I mean, you cannot fix a structural trade deficit with tariffs. You can't do it. And so all of the nonsense about, oh, this is really good for us long term and it's going to be deflationary. Well, if you crash the economy, that is deflationary. There's no question. If you crash global trade, Smoot and Hawley did that really, really well. But a whole generation of people were worse off for it. So I just think it's bad economic policy and bad economics. Look, Berkshire Hathaway, what do I think about it? Berkshire Hathaway is a leveraged index fund. That's all it is. So if you want to own leveraged U.S. stocks, fine. It's always going to outperform the S&P over a long period of time because it's leveraged. It's going to have the same volatility. Now he's got a little bit less now because he has a lot of cash because he's going to eventually use that cash to buy some good assets. But I just think if you want to do the same thing, you could lever the S&P yourself. And although he has an advantage of the tax treatment, so it's a good thing to own. Bitcoin's digital gold. Why isn't it going? Oh, okay. Why isn't Bitcoin going parabolic? It's a great question. So gold is physical, and you have to store it, and you have to put it in safety deposit boxes and all that good stuff in Fort Knox. And the issue with it is it is harder to deal with. Therefore, it's not as widely owned by financial investors. So it's owned by some financial investors, but by and large, it's owned by central banks and a few scattered investors, but it's not widely owned. So when you get liquidations based on over-levered positions and over-levered stock positions in particular, and you get a margin call, you have to sell something. You sell what's liquid, cash, bonds, and you don't really sell gold because most people don't have a lot of gold. So a lot of people, particularly hedge funds, bought Bitcoin and they get a margin call on their stocks after Liberation Day and they have to sell their Bitcoin. So that's part of it. Second part of it, and this does happen to gold, but I guess there's only so much capital, so they started doing it in Bitcoin instead of gold, is people can go short in the futures market and long the underlying, and that was happening in GLD a lot. But if you're short the asset and you get into a squeeze position, I think that's what happened with gold. So it's not alchemy. As you in the question you have, is it alchemy? No, there was a big short squeeze in the shorts on GLD, I think, and that's part of why it's been moving so fast. There's still a lot of shorts in the futures market in BTC, and not a short squeeze yet. I think there could be relative. If we get to 90K, a lot of people will get squeezed, and I think it could go parabolic pretty quickly. So, there's a little bit of lag with money supply growth, and the gold, all the pressure around gold probably does on the margin get some people to invest in that again. So we'll see. But my guess is by the end of the year, Bitcoin probably outperforms gold. I'd take that bet. But by the fourth quarter, we're probably back in the bear market, and then I'd probably want to own gold again. So, all right. I have to run to a lacrosse game, but I appreciate everybody's time. If you have other questions, don't hesitate to reach out. And we'll be back, hopefully with a different topic. But if they don't stop the tariff nonsense, we'll be back with chapter 4 in a few weeks. See ya.